Afternoon, everyone, and welcome back to the Peterson Institute for International Economics. We are delighted to once again have to our podium today not only Pierre Moscovici, European Commissioner, but also Marco Budi, Director General for Economic and Financial Affairs at the Commission. As I think and I hope many of you know, we view ourselves with some justification as the strongest outpost of European-related economic work in the US and probably outside the EU, and we'll match some of the things we do up with our friends in the EU. And this is in part because, frankly, there's a lot that we actually believe in about the European project, and we make no bones about that. It has been a pleasure through the last few years to regularly have Pierre Moscovici with us. Today, he's consented to have an on-the-record, ongoing chat. He and I will talk a little bit, and then we'll open it up for on-the-record questions and comments. He has to go promptly at 3:15, I believe, and then we will shift to a very high-level panel starring Marco Budi, Patrick Honohan, Charles Kupchan, Rebecca Patterson, and Jeremy Zettelmeyer. Just a word about Pierre. One has to recognize that he started life in some ways as a politician, as many at the Commission do. But he has been European Commissioner for Economic and Financial Affairs, Taxation and Customs now since 2014. He also had been French Minister for Economy and Finance from 2012 to 2014. So he's someone who passes even in these august halls as a technocrat if he wishes. And we look forward to a very frank and wide-ranging comments and questions about the issue of European reform, the European outlook, and most of all, as we titled today, the future of European integration after 20 years of the euro. Pierre, if you would, please. Hello? Perfect. So again, thank you, Commissioner, for joining us, and thanks to the delegation of the European Union for arranging this. Let me start with the big question, which you can take however you want. We're at the 20th anniversary of the euro. The European currency does not seem to have become the full-scale alternative to the dollar that some thought it would 20 years ago. The European economy does not seem to have integrated, converged, let's say, as much as many of us hoped when the euro started. Beyond inertia, keeping it all together, where should we think about the euro's progress in the years ahead? What should we expect?
Sure, thank you for...
Whoop, just press the button on there. Sorry. There you go.
First, thank you for welcoming me once again in the Peterson. I will try not to be too technocratic, I promise. Neither too politician, so I will try to find my way as well as possible. The euro is 20. That's still a very young currency. And I think that if we look at it with this idea that it's young, it's a success story, obviously, because it has brought us stability. It has ensured that we have now an independent central bank. We have very low interest rates in Europe, and that obviously helps consumption and investment. And if you look at the popularity of the euro, it's really high. We're not in a time now where people love Europe. I'm afraid to say so. We are seeing populist movements. We are seeing a rise of the extreme right all over Europe. Maybe we'll talk about that later on. And the anti-European feeling is certainly growing now with a part of nationalism. But the euro is very popular. I will just take an example. In 2015, Alexis Tsipras won the elections in Greece, and he tried to impose his country a U-turn against the program that was imposed to Greece for a few years. And he provoked a referendum in July, and just the day after, he renounced, in a way, to the previous political course that he has led for 6 months. Why? Not because suddenly he was converted to the logic of the programs, because 75% of the Greeks told him, we want to stay in the Eurozone. And with what you're doing, we would probably get out of the Eurozone. So the Euro is really a political asset. It's a stability asset. It's now institutionally broad-based, and we must consider that as a success story. But on the other hand, we know what we miss. And I would mention just a few things. First, we have no convergence. We rather have divergence. And this is obviously very dangerous because, let's call it another way, inequalities are undermining the European project and also the Eurozone. If the feeling in a decade is that it's always the same who wins and always the same who loses, then in the end, people will turn against the euro. And we see that in a way, the rise of populism, nationalism, the kind of yellow jackets movement in my country. I wouldn't say they come from the euro, but they come from this feeling that after the economic crisis, we still have the legacy of the crisis, which is called inequality. That's why we must still deepen the Eurozone construction, and we must add a second pillar to the stability pillar, which is the convergence and policy making for growth and jobs in Europe. And this is why the question of a Eurozone budget is so alive. I wouldn't say urgent because we are not dealing with it in an urgent way. Another point is that we need to complete our banking union. We have made a good deal of progress in the recent years. We established this banking union since 2013. We've got a supervision which is working now. We are completing the resolution framework. We also need to have a deposit insurance scheme. There is some resistance, especially from our German friends, but we need to complete that. And the third thing we need to complete is certainly the international role of the euro, because we're not the new dollar, obviously. And when we see some extra territorial moves from our American friends, let's look, for example, at Iran, we don't approve the attitude of the present administration as Iran is concerned. We were attached to the agreement, and we think we should have certainly have a better agreement, but not denouncing the agreement. Then we cannot act with the euro as it is. So we need to add an international role through financial vehicles, for example, and to increase the importance of this currency. So to answer shortly, that's where we are. A young currency, who is now the second in the world, but which needs to be completed and to have its international role strengthened.
You put a lot of different elements into that response, reflecting your comprehensive view and the breadth of your responsibilities.
I thought that's what you were asking me.
Absolutely. But now, so no complaints, but transition. Now, can I ask you a little bit more about some of the specific components? So let's start with the euro area budget. There is clearly, as colleagues of mine in this institute, including Jeremy Zettelmeyer, Olivier Blanchard, Nicolas Véron, and others, have written about, there is clearly a strong case to be made for greater countercyclical fiscal coordination or provision, frankly, in the euro area. There's, leaving aside the issue of political support or objections, what structure would you like that to take? What do you think if we were granted in the existence of a European finance minister, European budget, how should it be structured? How should the rules be changed? Again, we're coming to the end of this commission. You can afford to blue sky a bit.
First, this is a question on which I've been reflecting since my entry in the French finance ministry in 2012. And I still believe that we need to reinforce Eurozone, first by another governance. And that's why we still need a finance minister for the Eurozone. I've been in the room of the Eurogroup for 7 years. Once I called this a democratic scandal, not because I contested the decisions taken, but the way the decisions are taken. You cannot have, the Eurogroup room is that big. 23 people deciding for the fate of 10 million Greeks without anybody knowing what's happening in the room. And obviously, if you look at some sociology, decisions which are taken without control or with control are not the same. And we see clearly that there is a democratic demand, which is also addressed to the European institutions. That's why I still advocate for the finance minister for the Eurozone. His role would be to chair the EU group and at the same time to be the vice president of the Commission in charge of Euro and other financial. It should have been for my successor. I say should because we're not there. If you've got a Eurozone finance minister, then you need to have a control from the Parliament, the European Parliament. I don't think that we need to create a specific Eurozone chamber. The European Parliament can make it and be organized also with the Eurozone ministers. And then we need a Eurozone budget, which ideally should have a certain size, which should be dedicated to investment, to fighting unemployment, and with some stabilization capacities, the counter-cyclical, as you said. That's the idea, and I think that is still relevant. The problem is that I will end my present functions and this mandate in November. We have not made considerable progress during those 5 years, not enough, because basically the Council could not agree on that. We have no strong impetus, and we have also from Germany the idea that Eurozone budget is too ambitious. We are working now on a tool after the meeting of the European Council in December with a limited mandate, and we are making quite good progress. Where first we are going, that's linked to banking union, to have a backstop for the Single Resolution Fund. That's necessary. We're going to increase the role of the European Stability Mechanism, of course, without damaging the role of the Commission. And we're working on another tool, which is a reform delivery tool, encouraging reforms, financing the countries who are doing reforms for themselves and for the Eurozone as such. But I'm afraid that neither the size, neither the governance, neither the stabilization function will be taken sufficiently into account. And that's why I hope that we will find a deal by June, that the first Eurozone budget will be born then, or defined, because it has to be incorporated in the next multi-annual financial framework, the next budget of the EU 28 or 27. We'll see what happens. But it's not the end of the road. It's not the end of the story. In my view, you asked me to be frank also at the end of the minute, we need to be much more ambitious and come back to the initial ambitions to have a real budget which is capable of dealing with the issue of convergence. We are not going to make it with the modest instrument we are delivering. It's a good step forward, but it's not the high ambition that we need.
Thank you. On that, you and Director General Budi recall my colleague Jacob Kierkegaard led an effort here we did looking at history of American economic integration and some lessons for the Euro area. And one of the issues raised was how over time the US federal government got more budget, got more bond issuance. And there were two aspects to that. One, as Jeremy has written about, is a European safe asset. And then the other, as Jacob has written about, is the idea that you get more budget when you offer something specific. It's usually you find a program that people want and then you figure out how to fund it, not you get the capacities and you find the program. So first, you didn't mention European safe asset. It's fine to disagree with Jeremy. You can say that's not a priority. Or is it just something that would naturally come in the kinds of ways you're talking about? And secondly, if the budget is to be spent on something, you've twice mentioned sort of spending on convergence, what would that mean?
First, I didn't forget that.
No.
That the European safe asset must come in the framework that I described. And second, when we're talking about the budget, what is it about? if you look at the conclusions by the European Council, it's about competitiveness, it's about efficiency, but it should be more than that, about stabilization. We need to have a capacity which is capable of addressing the issue of asymmetric shocks in terms of crisis. I think we need also to be even better funded to finance investments, not only through loans. That's the Juncker plan, which is, I think, quite a success. Juncker plan is the capacity to implement some 500 billion euros through loans from the European Investment Bank, with the support of the EU budget and also the EIB capital itself, but with a very important leverage. And I think we need to have also the capacity to finance investments through grants, not only through loans. That's the definition of a budget. And third, there is a debate that is complementary, which is about an unemployment insurance scheme. And that's an idea which is raised by the Social Democrats mostly, which is now being pushed by Olaf Scholz, the German finance minister.
Who, by the way, will be speaking on this stage at noon tomorrow. Mark your calendars.
So I imagine that he will discuss that too, and you should push it that
I will. I will. Thank you. So, again, this is great, and let me just spin this out. Ask you to spin it out a bit further. So, what is in your view, what is the failure of the convergence funds or the convergence efforts to date that we can learn from so that we do actually get greater, faster convergence in future? Is it that we didn't spend enough, I keep saying we, but anyway, you didn't spend enough money? Is it that reforms weren't crammed down enough throats? Was it just not enough time? Why did the previous convergence funds and structural funds and so on not induce the convergence we wanted?
Let's come back to the euro.
Yep.
What is the euro about? It's a kind of trade-off, finally. The German side, it's a trade-off between France, Germany, with the arbitrage of the Commission. It's a Kohl, Mitterrand, Delors job. The Germans renounced to something which was highly important to them, which is the Deutschmark. That was huge. France was converted, but never applied that, to fiscal discipline. Everybody agreed that we need to have an independent central bank, not on the model of the Bundesbank, and Mario Draghi proves that you can do something different with the ECB than what a German president of the ECB would do. I think that Weidmann would be very different from Draghi, and much more comparable to what happened before. And Germany, I wouldn't say imposed, but the kind of ordo-liberal view, which is everybody must follow the same rules as far as fiscal issues are concerned. And basically, we did that since the beginning of the euro. And this is not a pro-convergence view. I remember when I was a young European Affairs Minister in 1997, I came in office with the Jospin government, and the debate with Helmut Kohl at the time was, should we have a large Eurozone or restricted Eurozone? And I remember that some of the Germans' friends then said, okay, Italy, Spain, Portugal, Greece, France had to be on board. That's the Club Med. And finally, we fought to have everybody inside. But we didn't establish distinctions. We didn't take into account precisely the idea of convergence. And we cannot have convergence with very different political and economic structures at 19 with only rules. We need to apply these rules, but we need to do that in a flexible way, and we need to add convergence instrument. And this is not present for the time being. And this is why it's quite logical in that framework that we have a divergence. These rules are not capable of addressing all challenges, all issues as such.
So, continuing in your competence of the euro, one issue that comes out from your comments is would a higher inflation rate in Germany, would a higher inflation rate in the euro area in general have sped convergence? And so one of the issues, and we have Patrick Honohan with us who voted on these things, and he can talk later, but one of the issues is, do you think that, like other central banks, the ECB has to overshoot to make up for failing to meet its inflation target, or is the asymmetric target fine as it is? We don't need to do anything.
First, nobody is advocating for more inflation in the EU. We have had the experience of hyperinflation in the 1920s, the experience of inflation in the 70s and the early 80s. I come from a country which had that, and obviously that's not an asset. I started my career as technocrat in the 80s and early 90s, before the euro. And frankly, we had then some 500 basis points higher than Germany due to different causes of inflation. So let's have no regret for that. And obviously, if there were more inflation, then the monetary target would be different, and we would have a more restrictive approach from the ECB. I'm not going to comment on monetary policy. First, it's a tradition from us, and second, I consider that the ECB has done a huge job under Draghi's leadership, that we owe him a lot, and that his vista must be fully trusted. So I'm not going to comment on that. So it's not about inflation. But what could we expect, and what can we expect? What must we expect from Germany? And I think you could challenge Olaf on that tomorrow. Germany is a country with fiscal surpluses now. That's a Schwarz-Null theory, and with huge external surpluses. So it has huge capacities to finance more investment for the country itself and for the sake of the Eurozone as a whole. It's not about creating inflation. It's certainly just about financing the necessary investment, both for them and for us. You cannot have forever that kind of imbalances of something like 8-9% external surplus plus 0.5, 1.5 fiscal surplus. This is not something which is in the long run sustainable. That creates an imbalance which is damaging to whole Europe and to the whole Eurozone. And that's why we are advocating towards Germany now.
I fully respect your desire not to cross into specific monetary policy decisions. And frankly speaking, personally, I fully share your regard for what the ECB achieved under Mario Draghi's leadership. But, what all central banks are now facing is the idea, and I would argue the reality, that their amount of policy ammo for the next recession is rather limited, that the effectiveness of some of their tools, including the LTROs that the ECB used, is probably down from what it was. Is this kind of discussion alive in Brussels and in European capitals, that notwithstanding issues of euro area design specifically, that come the next recession, if the instrument interest rate for the ECB is near zero, you may need a fiscal response?
This is something that is certainly in our mind. If you look at Mario Draghi recognized himself that the ECB is powerful, but that we must not expect everything from the ECB. Monetary policy cannot do the whole job on itself or by itself. So we need to have other tools. The problem that we have is that we still have a very important burden of debt in Europe, as well, public and private debt. And that is something that we must attack now, as long as we have growth, because we need to find there some room of maneuver if we want to be capable of having a fiscal response. So in the case of a recession, we will have to define probably another balance, because as you said, the ammos on the monetary policy are obviously now more limited than they used to be.
A final question before I open it up to our distinguished audience. You had mentioned, as part of your Gesamt concept at the start, about banking union, and our colleague Nicholas Veron has been I think, very persuasive in pointing out the big progress that was made, as you've said. The other day, the governors of the Bundesbank and the Banque de France came out with some kind of plea for capital market union, which struck me as kind of odd with the banking union sort of half finished. I'm not asking you to get in their heads, but how do you prioritize what comes next in banking union, what comes next in capital market union? Of course, we'd like to do everything all at once, but how do you think about these things?
I was interested to read this paper, and I agree with them. I don't think we should oppose or not even organize a different timing between banking union and capital market union. These are things that can go all together.
Right.
On banking union, again, we've made quite decisive progress in the last years. Now we've got a supervision mechanism which exists, which functions well, which helped to know what the situation of the banks were, and also to recapitalize them. And our view is that the systemic risks have been really downsized now, and that basically the situation of the banking sector in Europe is much better. Then you've got resolution. And for that, as I said, we need to have a backstop for the Single Resolution Fund to make it fully credible. I'm quite optimistic on that we can make it, and that the decisions taken by the European Council can be implemented, and that the ESM there could play a leading role. On the other hand, we've got Capital Markets Union. This was a grand vision from this Commission, which we made a lot of progress. I think that out of 17 pieces of legislation, we've got 12 in place, but there are still a lot of them that need to be developed. And we need to finally work as well through Eurozone budget, banking union, capital markets union. That would make our economies much more resilient, and that would also be a strong tool if we face a new recession.
Terrific. As I said, Commissioner Moscovici has kindly agreed to take questions on the record. We have a terrific group of people here. Usual ground rules. There is a traveling mic up front in Tarnisha's hands. There's a standing mic if you are near the back. Please identify yourself when asking a question, and please make it a question, no matter how fascinating your statement. Who would like to go first? Please come up to the mic. And then Tarnisha, then over there, please.
The lady there.
Yes, the lady there was supposed to stand up and go to the mic.
It wasn't clear. Thank you. It's Paola Subacchi, Queen Mary, University of London. Commissioner, I have a question. During your commission, the length of your commission, we had two episodes of breakages inside the Eurozone and the European Union. So Greece in 2015 and the referendum 2016 on Brexit. I don't want to discuss Brexit because really we are all bored with that.
We really
but
don't.
the thing is, can you get, I'm sure you did a fantastic job to create a robust union, but can you give us some example of how, in practical terms, you can be sure then the work you've done is not going to be unraveled by a new commission, which could be completely different, and a new parliament, which could be completely different, with different values and principles? We hope not, but is a possibility we cannot exclude.
That's politics. In this country, you have had Barack Obama. Now you've got Donald Trump. I don't know who you're going to get tomorrow. And obviously, the one who governs can change the course of things. I'm not going to expound too much on that. This could also happen in Europe. When I look at, I'm moving to the end of the mandate. And one thing that one needs to ask himself is, what have I done? And what would have something which would have been different from me do differently? I would basically say three things. First, Greece. This commission, as well President Juncker and myself, immediately we said Grexit is forbidden. It cannot happen. It must not happen. It's first for the Greeks and second for the integrity of the Eurozone. Obviously, some German conservative, I'm not talking too much about Germany today, But still,
On this issue, it's justified.
it's clear that we had a very different point of view with Wolfgang Schäuble, who is a close friend and somebody I admire and respect a lot. But there was a fight between Commission, France on the one hand, and Germany on the other hand. I'm quite sure that another commissioner would have done differently. And that with another majority, some would have been tempted to push them aside. This would have been an historical mistake. Second thing that I tried to do and succeeded in doing, it's another reading of the rules on fiscal surveillance. We were anti-austerity, not in the sense that we didn't want the rules to be respected, and they were respected, but because we wanted to introduce some flexibility. I consider that a sanction is not the right answer to a problem. We didn't sanction Spain, Portugal, Italy. We made a deal with the Italian government in December. We will have to come back to it in June probably, or next year. We'll see what happens with the Italian situation, which is something that we are looking closely at, I would say. And it's clear that another commission could do things differently. And the third thing is not in that area, it's about tax issues. I dedicated a lot of time to fight tax fraud and tax avoidance, to try to establish also new rules, for example, on digital taxation. That's what I'm going to discuss with Steve Mnuchin in a few minutes. And we are progressing through OECD. Another commissioner would have been different, and another commission can do things differently. So what are we certain of? We've got the rules, and we need to respect them. We've got the framework of the Eurozone. But, of course, there can be different political approaches, and that's why the European elections are important. That's why also the next Commission is important. And the next people in charge of those matters in the next Commission, it's also something which is important, if not strategic. We've got debates. This is a political body. This is a political union. And, well, with the same framework, obviously, that's the privilege of democracy. You can do things slightly different, not totally different. You cannot have a contest against rules or against institutions in Europe. It's a rules-based system, but it can be driven differently.
If only that were true in the US. Please.
Jacob Kierkegaard from the Peterson Institute. I guess it's almost kind of a follow-up on the previous question, but I would like to push you also a little bit on this issue of that Adam also raised on the fiscal integration in the euro area. Because, I mean, you seems to be basically both of you agreeing that the euro area is heading into whenever the next cyclical downturn happens, fiscal policy has to come to the forefront. And because the ECB will not be able to, it may be able to prevent the breakup of the euro, but it won't be able to prevent secular stagnation in Europe. So it's a fiscal policy issue. But at the same time, you said it yourself very clearly, the new budgetary instrument for the euro area is not deliberately designed for that purpose. So it won't do the job, even if you could envision that sometime maybe in the next crisis downturn, it could be scaled up. But if it doesn't have a counter-cyclical component, it's not going to matter very much. So my question to you is, if you to basically advise your successor, the next ECFIN commissioner and the next president of the commission, if they were called upon to be, if you like, creative and use the tools available in an imaginary sense for the commission to do this, the sort of Juncker Plan 2.0, but for explicitly counter-cyclical purposes, what could you do?
First, as I told you, this is a matter on which I'm not satisfied. I think we have not made enough progress during this mandate, not because of the Commission, because of the reluctance or divisions in the Council or in the Eurogroup about that. And we are progressing towards the first budgetary tool for the Eurozone, but it's not capable of dealing with all issues, and especially not with asymmetric shocks, not with a stabilization function. And this is why we must still have in our mind that for the future, we still need the triangle, a minister, parliamentary control, and a true budget that can be strong enough. But it's always better to anticipate. That's maybe not the capacity of governments, the best capacity of governance. But one thing makes me a bit optimistic if I look at the previous crisis, is that during the crisis, we are capable of delivering. In 2008, we didn't have the Stability and Growth Pact. We didn't have the two-pack and six-pack. We didn't have the banking union. Not at all. And so we didn't have the ESM. We had something which was before the ESM. And we have built all these tools during the crisis to address the issues of the crisis. So if we've got, I would say, a budgetary tool which is in place, and that's why the step forward is still important, then when the time comes, I imagine our successors could enlarge it. But, well, my message to my successor will be that it's unfinished business and that we need to keep straight with the old good ideas about what a true dedicated Eurozone budget should be.
Great. We literally have 3 minutes left because the meeting with Mnuchin has been moved up. So let me take these two. Tarnisha,
Sorry
you
for
could
that.
hand. No. If you could take these, the gentleman there, and then Fred, if you could give them the microphone. So next to Jacob, and then Fred, and let's get both questions at once. Then the commissioner can answer.
Thank you very much. Martin Luke with BlackRock. Commissioner, just one point. I would like to come back to what you were saying in passing previously on the Italian case. And that is something that looks to me like almost certain to pop up again around mid of this year, with a lot of implications potentially for financial markets, lots of, spreads rising, etc. Last year's budget of 2.04%, the draft that Italy presented, I think on the third attempt, was a clear provocation. I think everybody saw that, and I think that congratulations on your reaction.
I'm sorry, we have to ask you to
yes,
get to a question.
The reaction was absolutely right in not reacting to that and let it pass. But what is your plan for next time? Because this is a populist government and they will try the next thing again.
Okay, and Fred.
Fred Bergson at the Institute. Also in the context of unfinished business, you mentioned in your original remarks some frustration that the euro was not playing a bigger international role. The dollar enabled the US to do things like on Iranian sanctions that you were unhappy with. Are there steps that you're now trying to take, new settlement mechanisms, anything else, or that you would recommend to your successors to try to correct that frustration that you have?
Thank you, Fred.
On Italy, I'm not going to expand too much. Today, the Italian government is delivering its plans, its budget for its evaluation for this year and next year, 19 and 20. We need to evaluate that. On the 7th of May, we will deliver our own forecast for the Eurozone as a whole, and especially, of course, for Italy. And then at the end of the European semester, I would say beginning of June, just after the European elections, we will have to reconsider the way things are implemented. Italy is certainly a country, as I said, we are clearly watching, because we could have three kinds of problems that could interlink. The first one is an economic problem, and we know that there are either at a very low growth or nearby recession. All forecasts now are around 0.2, 0%, and even the Italian forecast is at 0.2. It's good that we've got the same figure this time, because in September they were saying 1.5%, which was clearly absolutely unrealistic. Then we need to consider the fiscal issue. The deal that we have signed with the Italian government must be respected, especially on structural deficits. I'm not talking that much about nominal deficits. Of course, can be a bit higher than 2.04%, but we're going to monitor clearly the structural deficit. And we are going to discuss that again and again with our Italian friends. I met Giovanni Tria, the minister in Bucharest, last Saturday. But we are going to do that, I would say, in a prudent and also constructive way. I don't want an opposition between Rome and Brussels. We tried to avoid that in December. We avoided that in December. We must still be in that situation. And then there is a political problem or political issue, which is this coalition stable? Are there going to be other elections at one moment? And I don't want to speculate on that. So I don't want to sound too alarmist. I'm not. We are there to create solutions. We will be in constant dialogue with the Italian government. We want to avoid the kind of situation in which spreads go high and to create any kind of market turbulence. This is a very important issue, and that's precisely why we are capable of making this deal. Because finally, the Italian government recognized that it was not in its own interest, even as populist as it is, to create a fight or a conflict with Brussels, with the European Commission. And so we will be in the same mood, basically. Lucid, conscious of the difficulties, but with the same method, which is dialogue, in order to move things in the right direction. Then, on the international role of the euro, this is clearly something which is a new item in Brussels. The President of the Commission mentioned that first in his speech on the State of the Union last autumn, and we are, for the time being, reflecting on what it could mean. If Peterson can work on that, it would be quite useful. But again, the idea is that we need to have the tools to address the kind of situation that we are facing in Iran. And when there is an extraterritorial sanction and there is no other vehicle than the dollar available, then our companies suffer from that. And we need to offer them capacities to resist to that kind of situation. That would be the first step. Then after that, we must think about how to increase the role of the euro as an international currency, such as the dollar. So we are now studying that, and this is an issue that will certainly be followed during the next mandate of the Commission, and that will also be a legacy for my successor.
Great. Thank you so much, Pierre. Please join me in thanking Commissioner Moscovici. He's off to save the world for digital taxes and afraid must run. We are delighted to have with us a high-level panel to continue the discussion of the future of European integration after 20 years of the euro. We will reconvene in approximately 10 minutes to start that discussion. Thank you. of today's session on the future of European integration after 20 years of the euro. We heard just a few moments ago from European Commissioner for Economic and Financial Affairs, Pierre Moscovici. We continue with an extremely high-level panel, very thoughtful, for which we're very grateful. And let me introduce them all at once so that we may get started and then ask them to come up. We'll begin today with Marco Budi, who has been Director General for Economic and Financial Affairs at the European Commission since December 2008, after a 6-month period as Acting Director General. For many of us, Marco has embodied the best of the Commission's technocrats, as a good word, and as devoted economists, and he's a devoted civil servant to the European project, and we're delighted to have him back here at the Institute. Following him will be the distinguished Patrick Honohan, non-resident senior fellow here at Peterson, but also, of course, had been governor of the Central Bank of Ireland and a member of the Governing Council of the European Central Bank from September 2009 to November 2015. He is now a professor at Trinity College Dublin, I believe, in addition to having a long and distinguished career writing about both trade and financial issues in great academic publishers. To provide a broader perspective, which we need, I've asked Charles Kupchan is Senior Fellow at the Council on Foreign Relations and Professor of International Affairs in the Wall School of Foreign Service and Department of Government at Georgetown. Many of us know Charlie as the author of such books as, I'm going to mangle the title, I apologize, When Nations Make Friends or When Nations Make Peace. How Enemies Become Friends, which I keep trying to read about internal U.S. politics. Very distinguished publication list and also service at the National Security Council on the Western European and European Affairs Desk. We have a markets perspective from one of the most distinguished and thoughtful market people I know, Rebecca Patterson, who is Chief Investment Officer at Bessemer Trust and a member of that firm's management committee. Prior to joining Bessemer, she worked at JP Morgan as Chief Market Strategist for Asset Management. And finally, to join Patrick on the PIIE representation front, we have Jeroen Zettelmeijer, who is now the Dennis Weatherstone Senior Fellow here. He's been with us since September 2016, and from 2014 until September 2016, he was Director General for Economic Policy at the German Federal Ministry for Economic Affairs and Energy, previously Deputy Chief Economist at the European Bank for Reconstruction and Development, and also, of course, a very distinguished scholar. May I ask all 5 of our distinguished speakers to come up to the panel. We have you in alphabetical order, and I will ask Marco Budi to lead us off.
Okay, thank you very much. Thanks for the invitation, for putting up this panel, and thanks to Adam for his unfailing support, including through a number of studies actually authored or co-authored by Peterson. I think some of the main contributors are actually here, either on the panel or in the room. You have listened to the Commissioner and his perspective. He has told me before, don't say things differently than I have said. So I'll, if you detect any difference, put it to misinterpretation on your side or misspeaking on my side. Now, I think one can safely say that a lot has been accomplished during the crisis under duress. But the job is definitely not finished. We have an agenda till next June. So June 2019 is the meeting of the Euro area heads of state and government. The ingredients for that have been indicated by the Commissioner: ESM reform, including the backstop, so completion, the second pillar of the banking union. the euro area budget, let's say at least in its embryonal form that the Commission has sketched out, and also an agreement on the future path to achieve EDIS, so the single deposit guarantee. I think the work is being done on this. I think we are going to achieve something not spectacular results, but something concrete in June. Then I think the question comes, what after June? And here I think we basically have two choices. And I'm thinking about that June we enter into the, let's say, or we are already, but we will enter towards the end of the institutional transition that was alluded to before. So new commission presidents, and also new incumbents in other fundamental institutions. So what happens and what should we do beyond June? I think we have, as I said, two choices. One is to carry on as we have done it so far. So it means that there is a number of open fields where we have to make progress, and we keep pushing and try to go forward and make the gradual steps and advancements. Essentially, if without saying it explicitly, that for a break, waiting for more difficult times. I don't want to talk about a crisis, to make more decisive steps. And as we know, we always find more courage when you face something a bit more existential. Or the second choice is to, in a sense, to draw a line and look a bit afresh to what we are doing in terms of completion of economic and monetary union. And I would say here, in order to make, let's say, more progress and more decisive progress, one would probably have to broaden the package from the current one on the table. So an element of a new articulation between, let's say, the fiscal discipline by rules, in market discipline, the issue of the safe asset was mentioned before. Adam, you put it to the commissioner. Central fiscal capacity. So to have an articulation which is, let's say, broader than the current one. I think it would be useful also at the time to look again and to revisit 20 years after the launch of the euro, the motivation for what we are doing. I think clearly here, first, the geopolitical relevance, and it was mentioned before, I think is, in terms of strategic motivation, is absolutely essential. So here, the international role of the euro, in a sense, moving from monetary independence to true monetary sovereignty, and do what is necessary in order to strengthen the international role of the euro. And I think if one goes back to the beginning of this, the official policy being no hindrance and no support, leaving to the market, I think there is an important evolution also on the side of the ECB, looking at the benefits of more work on that front. I think the second one is the need to achieve more indigenous growth. Now we are very dependent on the international cycle. We have seen that now that the global economy is decelerating, the Eurozone is suffering more than other areas in the world. And I think we cannot always hope that to be pulled up from more difficult times or recession because of China on the one hand or the US on the other hand. So I think here it will be very important to shed the small country syndrome, which is still has harbor in the Eurozone. In doing this, one cannot, and I think Adam mentioned it before, one cannot leave things only on the shoulders of the ECB. The room for maneuver there is limited. We can certainly the ingenuity of central bankers is, we have seen it during the crisis, limitless, but limitless up to a point. So I think we will have to see what one can do on the other side, and here the combination between what has to be done in order to foster potential growth in Europe, whilst at the same time using other tools, including fiscal policy, where the room is, I think, is essential. I think if you do the right thing, you can achieve, for instance, by boosting investment, both material and immaterial, both supply side improvements as well as, let's say, demand side support. And in this, the issue of banking union, capital market union, it came up before. I think we can revisit the case also for that. The link between achieving banking union and private risk sharing. There is a clear divide here between the US and Europe. So in a sense, the more you do on that front, the less you have to do in public risk sharing. So it may alleviate also some concerns on countries on the northern side of Europe. Now, how to do this? And I finish with the following consideration. I think in order to achieve this, we have to overcome the creditors-debtor divide, which has been created during the crisis, and in a sense recreate also, in order to make progress, Raoul's veil of ignorance in doing the reform. So you should not, by reasoning through the logic of creditors and debtors, process in advance always the little gains that you can get in terms of the and the losses. So I think everything creditors process in terms of risk reduction, the debtors process in terms of risk sharing. I think we had to break this. How to break this? I think in order to break this, we have, and I hope the new institutional cycle will also give an opportunity to that, to lower the discount rate of policymakers. So it means having a longer time horizon in the planning, and with the simple consideration that, and I repeat this including to my German friends, it is, I think, economically as well as politically, a big mistake to think that a creditor of today will be a creditor tomorrow. Shocks are different, developments are different. Think about what may, and God forbid, but may happen on the international, trade side. Should something unpleasant come from this side of the Atlantic, one can easily anticipate that those who suffer more are some of the creditors of today. So I think in lengthening the time horizon and breaking the creditor-debtor divide is absolutely essential for this. And I would hope, the Commissioner mentioned it, that we are good in responding to this when we are back against the wall. I would hope that we break also the ultima ratio logic that has that is the logic that has imposed itself during the crisis, and do something in a more preemptive way without waiting for the next crisis. Thanks.
Well, that leads in nicely to what I wanted to talk about. I'll start with an anecdote. In the 1970s, well, still today, but in the 1970s, there were two hotels in Basel where the central bankers come every 2 months, facing the Hauptbahnhof, the Euler and the Schweizerhof. They face each other across that square. And central bankers from creditor countries chose the Euler, and the rest, the Schweizerhof. They go to different hotels now, but that was then. And you can guess the countries.
And despite what Marco says for the future, and may be right for the future, no one has ever migrated between the two groups. And the divergent attitudes and interests of what are persistent creditors and debtors, or think of themselves as persistent creditors and debtors, will, I think, continue to influence and inhibit the functioning of central banking in Europe. This creditor-debtor divide is old. It intensified during the crisis. I think it will be durable. So we're 20 years into the euro, and that's not a short period. The Bretton Woods period lasted 27 years, for example, and we can talk about the gold standard and so on and so forth. So it's not a short period. So how has it done? Well, it was designed for limited goals. Let's remember that. It was designed for limited goals, maybe with a view to a very big future, but in the immediate, to lock in price and exchange rate stability with also an expected convergence of interest rates, and was designed for those limited goals in a world of moderate shocks. It was expected that the world had settled down to a world of moderate shocks, and accordingly it did reasonably well on inflation, 1.7% on average, even country by country as well as across the Union, and exchange rate stability. It didn't blow apart. Less well on interest rate convergence. It was not designed for shocks of the scale seen in 2008 to 12. And survival was not assured, but was achieved. So I think in a way it has done very well, given that it wasn't designed for the extreme circumstances that were encountered. But that also has disclosed some weaknesses. So give you an example of what was not anticipated. Well, interest rate differentials, they used to be about inflation and devaluation, they were driven by that. And suddenly, sovereign credit default risk emerged, and that induced a pro-cyclical dynamic, a new type of pro-cyclical dynamic which hadn't been considered before. It's a kind of, I call it the Neo-Walters effect, but we don't have time to go into that. But this created tensions that it took a long time to cope. How did policy react to the crisis? Well, I think we have to acknowledge that the policy reaction was dilatory and it was insufficient in scale, at least at first. Why? Well, there are a number of factors. Excessive conservatism, as well as an early tendency to regard the problems of stressed banks, stressed sovereigns as something special in a box. We'll deal with those separately, but we won't allow them to influence overall monetary policy, for example, or overall fiscal policy in the Union as a whole. So thanks to this separation principle, the conventional tools of monetary policy were not at first sufficiently responsive to the deep economic downturn. Fiscal policy also, but I want to concentrate on monetary. But there was another reason for hesitation to use more sweeping measures. And that's the deeply rooted fear in the once and always creditor countries, the denizens of the Hotel Euler, that the euro would be turned into an infernal machine for transferring wealth to the profligate. Now, I want to argue that this fear, which I stress is not groundless, has not dissipated, and that it represents a potentially permanent barrier to the full use of the financial might of the member states of the euro area in the broad interest of economic welfare. It doesn't mean that the system is dysfunctional. It just means that it doesn't achieve what it might achieve in a broader, in a different polity. It's true that much has eventually been done despite transfer phobia. Massive purchases of government paper by the ECB, the QE, it's only the most conspicuous of the measures that were adopted. And it gave the lie to some skeptical commentators who, in 2013 and 14, began to regard Mario Draghi's whatever it takes promise as potentially empty rhetoric. And the ECB showed that this was not empty rhetoric, and it is a big step. But the influence of transfer phobia is still reflected. For example, just to give you one example, in the limitations that the ECB placed on the scale of its holdings of any issuer. Much lower, for example, than the percentage reached by the Bank of Japan in its QE operations. And that limitation, it threatens to limit the ECB's ability, for example, to reopen QE purchases should a future slowdown warrant such action. And after all, QE would have more impact if it was concentrated, if the purchases were concentrated on instruments carrying a higher yield. Okay, it might be argued that such limitations, and it is argued, that some such limitations are driven as much by legal constraints as by policy. But if so, and I think that can be disputed, that just means that transfer phobia has already been baked into law. Now, it might need hardly be mentioned that each of the many suggestions for pooling sovereign debt or substituting some form of safe euro bond that we're all interested in have also fallen foul so far of transfer phobia. Even those schemes that have been most carefully constructed, and Germany hasn't been involved in this, to eliminate most of the threat that intergovernmental risk sharing would result. And the same story reemerges in relation to the common deposit insurance scheme. There are some areas where transfer phobia has had a constructive effect in building out the euro construct. Example, the creation of the SSM. Transfer phobia paved the way for the creation of this supranational bank supervisor, and it also helped ease the adoption of the tougher common rules for resolution of failing banks, BRRD. So it's quite a complex, has a complex impact on the way the euro has evolved and is evolving. But I'm sorry to say that I fear transfer phobia is likely to be with us indefinitely. And if I'm right, it means that the euro area will always have distinctive limitations that differentiate it from the monetary arrangements of a unitary state. Knotty problems such as the regulatory risk treatment of sovereign bonds in the balance sheet of banks are made even more complex by this reality. So this is a whole, you may be aware of this as a disputed, unresolved area internationally as well as in the European Union. And one does not have to be infected by transfer phobia to acknowledge that Greek sovereign debt restructure, it severely damaged the banks of Greece and Cyprus. And so, ex post, it's clear that they were riskier than was being acknowledged in the regulatory treatment. But for euro area official institutions to apply risk weights is like reducing the status of sovereign debt to that of a municipality, and doing so in a context where there is no overarching euro area sovereign. And that's the circle that hasn't been squared. So I give you that as an example of the problems that continue to chafe at the edges of what policy can do in the euro area. So let me summarize and conclude. Although it was not designed to be robust to the kind or scale of shock encountered in 2008 to 12, the euro's architecture proved sufficiently adaptable to enable the system to survive much better than many skeptical critics expected. Much has been learned, and we are now better placed for the next crisis. But my main point today is that the euro area is likely to remain different and to an extent more constrained than other monetary areas for two reasons. First, because the shared sovereignty that it embodies is limited and reflects the fact that the European Union is primarily a regulatory polity. And second, because transfer phobia inhibits some actions. And what these limitations imply is, of course, that private and public financial management needs to be much more prudent than it was in the years running up to the crisis. The single currency generates many sizable benefits, but it's not a free lunch.
I hate to follow you. Extremely eloquent. Thank you both. So I'm going to take this a little bit in a different direction. I've followed the euro from long before it was born. I started out my life as a journalist and spent several years in London and Brussels, running around to ECOFIN meetings and various summits and trudging around after the policymaker to get quotes as they tried to figure out the Growth and Stability Pact and the different criteria. And then at a certain point, JP Morgan, reading my stuff in the Wall Street Journal, said, "Why don't you come be a currency analyst?" So I was fortunate enough to be one of those people modeling out the convergence trades. What should a peseta be worth against the Deutschmark? What is the likelihood of convergence? What should the lira or the franc be worth in 97, 98, up until January 199? So I was on the trading desk the morning the euro was born. And at the time, I remember a lot of very credible academics and economists who thought this thing will never survive. And I disagreed. And I think partly because I had been fortunate enough to study in Italy and France, and I actually had a stage at the Council of Europe once upon a time. And I think I appreciated more than most Americans, at least, the history and the drive that led to the creation of the euro ultimately. So I believed in it. And the first year, it only got more naysayers when the value of the euro fell 18% against the dollar, just in the first year. And yet 20 years later, and I think we heard this from the commissioner, and I agree fully, there's a lot of reasons to call it a success. Not only is it the second most traded currency in the world today, but GDP per capita in the euro area is up 57%. Polls among Europeans, not polls, Polish, opinion polls among Europeans suggest that even if they don't love everything going on in Brussels, they like having the euro and they think it's good for the region. And I think partly because of those things, you see more people wanting to join, and membership has almost doubled since the euro was born. And I think qualitatively, but perhaps most importantly, it's been able to give Europe power to speak with one voice as one bloc rather than many smaller voices. And that makes a big difference on the global stage. The challenge in my mind, looking at this as an investor, putting money to work for my clients every day, is the conflict or the constant balance that you have local governments with economic and political priorities, and you balance that against the regional priorities, and you have to get to that balance losing the monetary policy and exchange rate tool for the local governments. And that balance works beautifully if all the economies are in sync. But it doesn't work at all if the economies get out of sync. And so in 1998, when the governments were forced to converge, in 1999, all the economies were in sync and EMU worked. And it worked for the next, basically, decade because you had very strong global growth. And to the point made earlier, almost 50% of the euro area is exports. And so if you have China joining the WTO and this wave of global growth led by emerging markets and a strong US, Europe was on steroids, lifted by that double tidal wave, if you will. And so everything was okay. But as soon as you see a structural slowdown in China and you see the US slowing down and the trade falls apart because of trade wars, it's very hard to get that balance to work anymore. So when I look at Europe today, I see both short-term and more long-term structural challenges. In the short term, I was at an event last night with a few German policymakers who were saying, "Oh, don't worry, in the second half of the year, it's going to be fine." I'm like, okay, why? And it might be, but there's some assumptions here. We're assuming U.S. and China will have a trade resolution that will lift global trade and manufacturing and business sentiment, and there won't be any other trade tensions, for example, between the U.S. and Germany over autos that replace that. So manufacturing will get a lift, global trade will get a lift. We're assuming things with Italy will be messy but muddle through. We're assuming the European Parliament might be a little messy but will be okay. We're assuming Brexit just gets forgotten about because we're so tired of it. And we'll deal with that again in October. But there's a lot of assumptions here to assume that we get the second half lift. And if we think there is that lift, if we think we have this amazing trade deal between the US and China, where would I rather put my capital, in Europe or in China and emerging markets that are going to have a much higher correlation with that lift to global growth and trade? So what you've seen this year is money going to emerging market equities and Chinese equities who are taking that view that that good outcome might occur. Europe is going to benefit, but from not as much. So why would you bother with it? So you have that conundrum in the short term. And then when we look further out, the U.S. is going to go from fiscal stimulus to drag next year. U.S. economy already expected by consensus to slow. The question is how much. China is stimulating, but structurally is slowing as well. So those engines of growth helping Europe are both going the wrong way. So unless you have this indigenous organic growth coming out of Europe, and the unemployment rate is very low, and the consumer is in a good place in Europe, generally speaking, and construction is doing all right in Europe, generally speaking. But unless you see that lift from somewhere, they're going to be pulled down as well. And what's the reaction function? You mentioned the ECB, and I agree. I think there's both political, legal, cultural constraints that are going to prevent the ECB from doing as much as it might need to. And the fiscal space, even if Germany and Netherlands have it, it's not clear to me they'll use it. So I worry that Europe is going to be challenged going into the next downturn, and the market is going to vote very quickly that they're not doing enough. And then you are going to see stress. And then it's a matter of, does Draghi's successor do whatever it takes? And does that whatever it takes prove large enough to turn things around? One last point, and I apologize because this is very dark, and I was a huge Euro fan for the last 20 years. This is a relatively new view of mine. Structurally, the thing that I can't get my head around is demographics. And I say that on two fronts. One is just that the labor pool in Europe is shrinking. It started shrinking in 2013 and will continue for the foreseeable future. And unless you have women, families suddenly having more kids, or you have a sudden change in social and political acceptance of immigrants, which doesn't seem likely after 2015, or you have some magic technology that lifts productivity, GDP is going to be challenged there. So that demographic issue, bless you, worries me. And the second demographic issue is more philosophical and maybe psychological, and that is when I think back to those meetings where I would follow around Helmut Kohl in his unusually large car, and sit in the back of the room as they talked about these meetings, I thought these people all are coming to the table with memories of World War II. You know, they were children after World War II. They know someone who died in World War II. And if you were born in 1945, you are now 73 or 74 years old. We have an growing number of leaders in Europe who are in their 40s or 30s. I think we even have one or two in their 20s now. It doesn't mean they don't care about Europe. It doesn't mean they won't be passionate about making the euro a success. But the institutional memory of why the euro exists, I think, is probably fading on a relative basis among leaders and voters. And when the stuff hits the fan the next time in Europe, are they going to have the same motivation to keep it together? Will they appreciate the reason why it exists? So those are the structural things that worry me. I think that if the euro wanted to be internationalized, it's very easy to do. In theory, it's creating a harmonized bond market. If Europe put all of its national bond markets together in one big piece, it would rival the US Treasury market immediately. Unfortunately, for political reasons, I think it's unlikely to happen during my career. But that would be a way to get much more depth and usage of the euro and have a safe asset, again, overnight. Otherwise, I think you have fragmented markets that don't have the liquidity. They have more volatility, and that's why during every last recession, going back to the 1970s, U.S. markets have outperformed European markets, even if the crisis was created in the United States, including in 2011, the last time we had our debt ceiling debacle and the U.S. credit rating was downgraded. U.S. markets actually outperformed European markets. The dollar outperformed the euro, even though it was our own darn fault. And that's because of the liquidity of our currency and the fact that we do have a safe asset. And Europe to this day certainly has German bunds, but the liquidity of that market is too small to serve that role. So maybe I'll stop there with my remarks. Just to be clear, I'm not calling for the breakup of the euro by any means, but I'm notably underweight European assets in my portfolio and continue to think I'll hold that position for the time being.
Rebecca, you started off by saying that you're a bit of an outlier because you started as a journalist and then became an investor, but I can outdo you in the sense that I don't do this stuff. Coming to the Peterson Institute is for me a little bit like going to another planet because I live in the world of geopolitics and tanks and ships and NATO. And I think that's why Adam asked me to come today. That is to say, to offer just a different take on where are we in the project of European integration and what's likely to come in the days and months and years ahead. And most of the conversations that I go to these days are pretty gloomy. I don't know if that's the case in the world of international finance. And so I want to counter that trend by starting off with some more upbeat remarks, because I'm on balance upbeat about the future of the EU and the Eurozone. And then after being a little bit more upbeat, I will end with the things that worry me, the other side of the ledger. The first point I'd make is in some ways the most obvious point, but it often gets overlooked, and that is that the project of European integration remains one of the most, if not the most successful experiment in geopolitical engineering in history, at least in modern history. I can't think of any other incident, episode in which a group of countries this large with a population so large has come together and created a community in which war has become unthinkable. Now, I can't guarantee you that it's going to remain so forever, but it remains so today. And when you read European history and you think about how many people have died on the Franco-German border and on other borders in Europe, this remains a miracle. And I do worry to some extent about whether that miracle is sufficiently appreciated by younger Europeans, and whether this is going to be a problem as we cycle ahead. But I do think that that fact, that observation should remain front and center in all debate about the future of the European project. Second point, I remain impressed about the degree to which the EU has remained politically coherent despite being pulled centrifugally by Poland, Hungary, Italy, Brexit. You know, when I look at the issues that I tend to follow, they're not issues of convergence and currencies, they're the political ones. Europe is hanging in there. On, excuse me, dealing with President Trump, I would have thought that Trump would have succeeded by now in picking off somebody, the Poles, the Hungarians, the Italians, and cracked consensus on some of the core issues. That hasn't happened. It hasn't happened on dealing with Trump on trade. It hasn't happened on dealing with Trump on the Iran deal. It hasn't happened on Brexit. And in some ways, to me, most impressively, it hasn't happened on Russian sanctions. If you had told me at the beginning of the Trump administration that we'd have a president who wants to recognize Crimea and drop sanctions, and that Italy would elect a coalition government, one part of which is very pro-Russian, and that Merkel would announce that she's leaving the scene, I would have said, Russia's sanctions are dead in the water. But they're not. They're still there, and the EU is hanging tough on this issue in ways that I would have never expected. And even on the tough issue of immigration, there has been a consensus. It's more by default than by design, because the Poles, the Hungarians, and others have rejected the initial plan that the receiving countries put together. But nonetheless, when it comes to bribing Erdogan and bribing the militias in Libya, there is a kind of a working way forward on these core political issues. Third point, and Pierre mentioned a few of these in his remarks, the EU continues to exercise a magnetic and disciplining attraction throughout its neighborhood. Look what happened in Greece. I remember when I was in the White House, one of the more interesting meetings I had was with Mr. Varoufakis, the first Greek finance minister, right? And he comes in and he's wearing a black turtleneck and he's wearing a leather jacket, and we sit down across from each other in one of these nice rooms. And he spends an hour denouncing capitalism and Brussels and breaking out of austerity. And I'm thinking, Jesus, man, it's going to be game over. Goodbye, Greece, right? Out of the Eurozone, maybe out of the EU. And what happens? Tsipras throws him under the bus, throws other extremists or whatever you want to call them under the bus, and becomes a mainstream centrist European politician. The same thing has happened to some extent with Italy. Italy blinked when it came to the budget. Poland has recently blinked on the courts. And so the idea that in the end of the day, countries are going to break away from the Eurozone or risk not hanging tough in the Union, that's not happening. Governing is very different than campaigning. When you're in office, you do what you need to do to stay in. Final point, on the euro itself, and here I'm a bit out of my depth, and I take the point that many economists and others made that the euro doesn't have the institutions that it should. It has led to imbalances. It has led to some extent, the crisis of the periphery. It has led to inequality. I take all of those points, but I do think, and both Rebecca and Pierre mentioned this, the euro remains popular. Two, that in general, when you look at other experiments in union making, single currencies matter and matter a lot symbolically. In the case of the United States, we didn't have a single currency until after the Civil War, and it mattered. It helped create a sense of the United States as a singular country rather than a states union. And I think the same thing is true in Europe, even though I haven't done the homework to see if there's polling data to back that up. And then the third point I'd make here, and this may be somewhat more controversial, the flip side of the imbalances that we've seen in the Eurozone is German wealth and German power. And I think even though there is a backlash associated with that, resentment against Germany, I would prefer to see German-led political structures in the EU than the opposite. Do we want a strong Germany helping to lead Europe or a weak Germany that's struggling economically? I'd take the former any day. And in that respect, I think the euro has helped create a Europe with strong German leadership. Now, on the other side of the ledger, and this may be a little bit darker, I don't know whether on this side of the Atlantic or on the other side of the Atlantic, what we're witnessing is a historical inflection point or a temporary detour. I have to say that for the first time in my professional life, I live with existential fear. I don't like what I see, smell, feel, hear. I never thought that the populism, the racism, the white nationalism, that I would ever see this in my lifetime. But it's with us, and it's in this country, it's the UK, it's France and Germany, and I don't know whether it is about to abate or whether it is about to build. The pendulum could go either way. And if it builds, I don't think the EU is going to survive. I don't think that if nation states come back to life and borders come back to life, that this experiment is going to be a success moving forward. And on balance, I think it will be, but if the pendulum doesn't start swinging back, I think we're all going to be in deep trouble. And I think, at least in my mind, we know what the source of this is. It is this kind of the digital age, the information revolution, the disorientation associated with immigration and socioeconomic insecurity. And I do worry that we are at the tip of this iceberg. Right? If automation and AI kick in and deepen in the next 10 to 15 years, what's that going to mean for wages and employment levels? I don't know the answer to that, but it is a pressing question. The second observation here is I don't think that the EU has moved past the point of no return. In the case of our country, the United States, it took more than 100 years. I don't think we were past the point of no return until the end of the 19th century, arguably into the 20th century. And in many respects, that point of no return involves capacity on defense and security and geopolitics. That's what really knit us together. It was 1898, the Spanish-American War. It was building battleships. It was World War I. The EU hasn't really passed through that inflection point, but it's debating it today. And we'll see where that debate goes. But I do worry that Macron is kind of out on a ledge on this front. Merkel is being very cautious and reticent on some of the proposals for defense. I found it very disappointing that a couple weeks ago, she not only didn't agree to go anywhere near 2%, but she came in at under 1.4% on defense spending. And some of you may have noticed that Germany is in the throes of a bitter debate now on revising its laws on arms exports, which are very restrictive. In fact, look a lot like our restrictions in the 1930s, when we applied them equally to any belligerent and helped Franco win in Spain as a result. But I do think that this debate on defense is a critical one. There's more wind in the sails than I think I've seen in a long time, but I don't know whether this is another false start to turn the corner on defense capacity or whether this is going to make a real difference. Finally, I would simply end by saying that to me, the debate in Europe is the same as the debate here, even though Europe does have this own debate about Eurozone reform and Eurozone budget, everything we've been talking today. And because I think both of our societies, whether the pendulum starts swinging back or swings further and further toward the extremes, we have hard work to do on the future of work, on immigration, where we have an immigration policy that's broken. Trump is right. He has terrible solutions, but he's right, it's broken. And on social inequality and social integration. These, to me, are going to determine where politics heads on both sides of the Atlantic.
Thank you. So this panel is increasingly becoming a hard act to follow, particularly cumulatively. It's becoming a hard act to follow. So let me give it a try, and you will see there are some of the themes that you've heard, but with a different spin. So the question that I thought I might address is whether we will still be having a 40 years of the Euro event in 20 years. And so I guess the premise of my approach to addressing this question is what Charlie just said, that I don't think so the Euro is in a deep sense beyond the point of no return. And so since that's the case, so the useful way of answering the question, I think, is to think of mechanisms or sort of avenues which might cause the Euro to break down, either as a whole or in part. So this is going to be just a tiny little more technical than at the beginning than the rest of the panel, but then I will swing back to some of the themes that you have heard already. So here's one way of thinking about ways in which the Euro might break down. So you can have involuntary exit as a result of market pressure. You can have voluntary exit. So this is the case when there is a political majority in a country that believes that the country is better off outside the Euro. And then in the middle of these two, there's a thing I would call sort of semi-voluntary or semi-involuntary exit, which is the case in which a government does not wish to exit, but neither does it wish to conform to the conditions imposed by the European institutions, the ESM, the Eurogroup, to provide it with liquidity to stay within the Euro. Okay, that's sort of this difficult in-between case. So involuntary exit, I think, was an important issue until 2012. And the reason why it was is because sort of we underestimated in the design of the Euro the possibility of runs on government debt markets, because of the lack of the central bank as a liquidity backstop for governments, which even if only used extremely rarely or perhaps never used, is certainly one of the reasons why we do not see rollover crises in countries like the United States. And so, in the presence of such a run and without such a backstop, you would lose market access, you would turn to your own banking system for financing. That banking system would then, after a while, run out of collateral to get liquidity from the ECB. And then the ECB would quickly hit its legal constraints, resulting in a national liquidity crisis, which eventually forces the country to introduce a national currency, right? So that's the mechanism that we almost had in 2011, 2012. And that mechanism, in my view, was sort of decisively addressed by the combination of the ESM and the OMT, the Outright Monetary Transactions Program of the ECB. So a country that is willing to engage with the ECB now benefits from effectively an unlimited supply of liquidity. And so involuntary exit in that original sense is no longer possible. Now, what is possible is what I just called a semi-voluntary exit, which is that, in principle, there is this unlimited supply of liquidity out there, but the country does not want to bind the conditions to access that. And we saw a case of this in Greece in July of 2015, where, clearly the government wanted to stay in the euro, but it was not only off track in its program, but it was not constructively engaging with the Eurogroup anymore. And so the ECB refused to increase the ceiling for emergency liquidity assistance to the banking system. And if this had lasted a little bit longer, Greece would have been forced to introduce a parallel currency. And then finally, there's this issue of voluntary exit, which has to do with political majorities turning against the euro. And so my basic point is that even though the type 1 problem has been addressed, type 2 and type 3 problems remain on the table. And so the question is what would take it to address these other two problems. So very briefly on this, what I call semi-voluntary exit. So the holy grail, I think, would be to find a way to refinance the banking system of a member country through emergency liquidity assistance, even when the government is not cooperating. And so that right now is not possible, because when the government is not cooperating, it can turn or attempt to turn its banks into a money pump for the government, and then you quickly lead those constraints. So, the idea that I sometimes kind of dream about, but everyone tells me it's absurd, is that the SSM might, in fact, so the central European institutions might be allowed to take control of the national banking system in a specified emergency, and that would allow ELA to keep going. It's effectively sort of allowing the government to do its own thing, but sort of cutting off the link from financing the banks to financing the government. Okay, so this is very unrealistic because, so I gave this, I formulated this idea in a little more detail at a conference in November. And when I did this, Martin Hellwig, the German economist, asked me subsequently whether I also thought the SSM should have its own troops. Okay, so short of not, pursuing this idea, I think the best thing that can be done to avoid this semi-voluntary exit problem is to avoid non-cooperation with the ESM by ensuring that ESM programs are as painless as possible. And that brings me to sort of one of the, I probably would be among the people staying in the Euler rather than the Schweizerhof. So to one of the themes of my work in the last few years, this would require reducing the cost of sovereign debt restructuring as an alternative to ESM-imposed austerity. And of course, to ensure that there is, in fact, an ESM program that can deal with any solvency problem, no matter how deep, which is not true if you cannot restructure debt. Okay, so now on voluntary exit. So this is now the political problem. If you want to prevent countries from voluntarily exiting the euro, you need to address the deep causes of anti-euro sentiment in both the North and the South. And so, Patrick, you unfairly already singled out the North for its anti-euro sentiment, which is what you call transferophobia. So what I call it is that this trauma that the no bailout clause has been violated in the case of Greece, that it might be violated again, and so that basically the North can be turned into a money pump for the South. But then the South, of course, has its own trauma, and that is austerity during the crisis. The euro is a straitjacket that imposes downward pressure on prices and wages at the cost of high and persistent unemployment, so even beyond the crisis, right? That's the continuing trauma in Italy today. And of course, the trauma of being very vulnerable to swings in market sentiment, because you ultimately do not trust that you're really going to have access to the ESM and the OMT at conditions that you find would be politically acceptable. And so the 1 trillion euro question here is, can you address both traumas at the same time, right? Because they really do seem to be deeply contradictory, as addressing the trauma of the North would require more discipline and better enforcement, whereas addressing the trauma of the South would require more risk sharing, including public risk sharing. And risk sharing, at least in conventional economic thinking, undermines discipline. So, which brings me to my punchline. So with some economist friends, including Nicolas Véran here at the Institute and academic economists from both France and Germany, we sort of argued a little over a year ago in a report that in fact you could reconcile addressing those two traumas. And the logic of the argument is as follows. So if you create the types of safety nets that were part of the, I think what Marco called the broader, the more ambitious agenda. So, not just European deposit insurance, also European unemployment insurance, reform of fiscal rules to remove some of their inherent procyclicality, reduction of concentrated exposures of banks, creation of a European safe asset, and which would then be held by the banking system and other systemic financial institutions. So these types of reforms might address the South's desire for more safety and less austerity, but by limiting the cost of debt restructuring as an alternative or as a complement to lending to deeply insolvent countries, they would also make the no bailout rule credible, and that would address the trauma of the North. Now, importantly, that whole thing, this construct that you can have more discipline by basically creating safety nets that allow you not to bail out, at least not to bail out in the sense of expecting a systematic transfer in one direction. It only works if the new safety nets do not themselves become a source of moral hazard, right? So that's the trick. So they need to be carefully designed. But then we argued that, there is such a thing as private, commercially viable insurance. And so the insurance industry has figured out some of these tricks, and the basic tricks are very easy. You have first losses that are covered by the insured, and you have risk-based insurance premia. And these principles can be applied to public safety nets as well. So we thought we had solved the problem, right? So here we have sort of this set of Pareto improving reforms. And, so we got a little bit of traction, right? A little bit of the spirit of this report. By the way, we have another co-author, Beatrice, who is sitting in the audience. It sort of made it into the Meseberg compromise between France and Germany. But by and large, we didn't get very far. And the reason for that, I think, is that while our approach can potentially address both traumas, it also requires both sides to take, from their perspective, significant risks. So the North must agree to new safety nets, which, if abused or poorly designed, could create new sources of redistribution. The South must agree to more market discipline, which, if not fully offset by better safety nets, could make high-debt countries more vulnerable. So, potentially Pareto improving outcome, but with risks if what is offered by each side does not deliver. And so getting out of this dilemma requires not just nice technical solutions, but also trust and leadership. And so, I've increasingly sort of over the last 12 months I've become pulled into Charlie's direction. I think so the right way of thinking about Eurozone reform is like an arms control negotiation. So there's this potentially Pareto improving outcome out there, but it's a very narrow path. And if you somehow get screwed by the other side, you're going to end up worse off. And so, if that's sort of the way of thinking about it, maybe there are two ways in which we might succeed. And in addition, there's a big way in which we might not succeed. So, one way in which we might still succeed is like détente in the 70s, and then again in the second half of the 80s. So, incremental steps, confidence building, gradual reform. So maybe this is what I think, I think you called it lower the discount rate of policymakers. Maybe that's what's going on right now. And so maybe in that sense, what has been agreed at the last EU summit in December is somewhat meaningful. And this can then continue until the weaknesses of the present architecture have been substantially reduced. The problem is that in the meantime, you cannot have a new crisis, right? Because otherwise you're back to square one with your old imperfect architecture. The alternative way forward is we have a new crisis which has just the right degree of catastrophe. It's not catastrophic enough to destroy the euro, but it's sufficiently catastrophic to really forge consensus for fundamental change, right? And so here the main risk, of course, is that the crisis might be either too catastrophic or not catastrophic enough. So I think we have started out on path one. I very much doubt that we are going to get far enough on path one before the next crisis hits. So at this point, I'm hoping for the right kind of crisis.
I hope you all agree with me that was an extraordinarily rich, engaging, thoughtful, and thanks not just to Charlie, everyone, multifaceted panel. I'm going to indulge myself as chair to tell a very brief story, since everybody's telling about their first encounters with the euro or whatever, and ask a question before opening it up. So when Rebecca was out there being currency analyst, I started my career at the Federal Reserve Bank of New York. And because I had lived in Germany and spoke some German and done a little bit with Germany on my dissertation, I ended up being the Germany desk at the Federal Reserve Bank of New York. And this was 94 to 97, before Fred gave me a job. And so I got to do fun things like, oh, what's the spread between Bunds and Swiss bonds, and things like that. And, how likely is it that this euro thing is going to take place? And shortly after I came to Peterson, then the Institute for International Economics, and Fred hired me, I was invited to spend a few weeks in Frankfurt at the Institute for Kapitalmarktforschung, the Center for Financial Studies at the university. And I was asked to give a lecture, and I gave a lecture called Why EMU is Irrelevant for the German Economy. And the point of this lecture was not so much what the title said, unfortunately. It was more that it basically said, I expect there to be zero convergence as a result of monetary discipline. That if you build the system that because there's tight monetary credibility, you will induce Italy into becoming Denmark or Germany, it will not happen. That was the story. And, I think that ultimately is at the heart of this, both economically and politically. I think Marco and Patrick, talked about the two sides of the creditor-debtor divide, and Patrick, of course, is right. Empirically, nobody ever seems to switch. Marco, of course, I find stimulating and right ethically to think that you want to have this Rawlsian belief that you could someday be the one who needs the help, and that goes to Jeremy's point about the safety nets. And so that gets us into the issue which Charlie talked about and which Rebecca, frankly, talked about, which is how do you build the solidarity? And is it a generational aspect, a historical moment, or is it something more than that? Because, as I put it, we had many discussions internally at Peterson. I'm sorry to be so self-indulgent, but as I put it about Greece and about Ireland during the early days of the crisis, including when I was at Bank of England, it's you got to decide that your cousin who has a drug problem, you got to decide you want her or him in the house, well-fed and clothed, whether or not they give up the drugs. You don't want them out on the street. And I was sorry to put it so crudely, but the point is it's a European family, and you had to do it that way. So this gets too cosmic. So let me try to put a question starting to Marco, and then Marco, of course, should get some opportunity to respond to the other panelists. But maybe picking up on some of the things that both Charlie and Jeremy said, and this relates to the volume that Jacob and I edited. Maybe it is external threat that matters. It was the horror of World War II and World War I and the Franco-Prussian War and all the rest that brought Europe together. And maybe the combination of an aggressive, nasty US and aggressive, nasty Russia and potentially aggressive, nasty Turkey, maybe that is what forces Europe together, because you unfortunately need some sort of external threat to build you up. And that relates very much to what Rebecca said. Maybe there's an external threat to the currency. I mean, Fred and others have pointed out that there may be certain people, particularly in the German auto industry, who like the ongoing sort of undervaluation of the euro relative to the Deutschmark would have been. But just as the Chinese discovered, you can have a little bit too much of a run on your currency, right? So maybe some combination of external threats is what gets us through the next 20 years. So anyway, Marco, what do you want to say?
Okay, thank you very much. First of all, thanks also for all the extremely stimulating. I hope this is not too much of a biased sample, because
Well,
on this side of the Atlantic, I must say we are a bit pro-European here. But but let's take it as an encouragement.
We got a German and Irishman and Italian Brusselite and two Americans. It's pretty diverse on at least that basis.
I'm and let's say the constructive tone of all the interventions is very heartening. Now, on your point, and then if I may, a couple of comments on the other interventions. No, I think, and I mentioned it, I think, in my initial intervention, the geopolitical element adds big time as a motivation for doing what is necessary domestically. And I think it is pretty clear that any external projection of strength, let's put it in strength here in inverted commas, can only be achieved if you have cohesion at home. So it starts from strengthening inside to project project strength outside. And for this, I think Rebecca mentioned it, and in a sense, you have also the bridge to the safe asset discussion. You need a large, very liquid market here to get the euro, taken off as a geopolitical currency. I have to say one thing, that when and I see people like me, I mean, when we work and we work every day, we have our nose in the plate, and we don't see very much the. But if you take a bit of a historical perspective, we have undergone as a Eurozone a systemic existential crisis. During this period here, the Eurozone enlarged. I mean, we had enlargement to Slovakia, 2009, and then with the three Baltics coming in the midst of the crisis. So I think in terms of, let's say, historical relevance, and this obviously is relevant also to because I mean when the Baltics came in, they came in with the strong political premises, and not only for economic reasons. And if you travel around the world, and I do it in with the within the G20, we have the discussion now here, but in the bilateral dialogues that we have with most, if not all, the G20 members, there is a very strong demand for Europe. I mean, I've been a few months ago to India. I've been to China also. I mean, the role of Europe in terms of both the model that we project compared to the cutthroat capitalism that you have here on the one hand, and on the other hand also the kind of let's say guarantor of the agreements. Because I mean, one of the problems that we are facing now on the trade side, we know, for instance, what China should do, and the list is very clear. You go from excess capacity in intellectual property right, debt transparency, state-owned enterprises. I mean, the list is well established. The fear there is that at the end of the day, the US would move the goalpost. So, and this is sometimes conveniently taken as the reason for not doing certain things in the first place. So, should Europe geopolitica play the role of standing by the agreement and guaranteeing that we all behave in a certain way, I think would help very much in the international sphere. So look at the next college, next institutions, institutional characters that we'll have in a few months. I think the geopolitical role of Europe is going to be a very, very important dimension of all this. Very nice, the transferophobia of Patrick. Here, and Charles mentioned Varoufakis, we need adults in the room. Because on many of the issues which are associated to transferophobia, the design, I mean, which are very charged ideologically, you can design them in a way not to have permanent transfers. And this goes from the central budget, it goes to the deposit guarantee, also the safe asset in Germany here has done an excellent work on this front. So I think we have to make sure that we move away from these, ideological perceptions. It is not easy, but an effort has to be done. Germany, I think it was mentioned, has profited a lot from Europe and from the Eurozone. I think one thing that in which one can criticize also the Chancellor, I have to say, well beyond my pay scale, but it has never been explained to the German public. So the miracle of Germany is in the perception, domestic perception, is associated to the reforms done essentially under Schröder, Hartz IV, and the other reforms there. Part of the truth, but a big part of the truth is the Germany embedded in Europe, both vis-a-vis the euro, so preventing the over-appreciation of the Deutschmark, and vis-a-vis the East European countries through the value chains that have developed there. So it has never been put in a proactive way to the German public. Since it has not been done, once we had to devise the programs and the help and solidarity vis-a-vis Greece and vis-a-vis other countries, the public was not ready to embrace that with in terms of solidarity, because and then all the ghosts of the past came back to host us. Let me see. One final thing is, or two maybe. One is on Charles on the role of Europe in a number of policies. I think to put it in a conceptually schematic way, Europe in economic terms, but not only, if you think about the intervention in the pre-market, in-market, and post-market. So pre-market is essentially the question of endowments. So investment you make, material, immaterial capital. In markets is the way to protect competition and foster reforms, etc. And then post-market is the solidarity element, so the redistribution side. Of the three, Europe operates essentially in the second dimension. So we have competition policy, we have policy for the single market, trade policy, also implementation of the fiscal rules in my own kitchen. So all this is the in-market dimension. So the question I put to you, all of you, is this a political equilibrium? Basically operating only in that dimension there, where you have the issue of equality of opportunity in the pre-market and the issue of redistribution and, let's say, equity in the post-market. Now, it seems to me that this is not, I'll give you my answer, this is not a political equilibrium looking forward. You cannot have only the harsh face of Europe on the one hand and let the member states to pick up the pieces in terms of solidarity. And final, very final, and I apologize for being too long, on Jerome, what is sketching out, in a sense, articulating in part a bit what I called which is, say, a broader agenda. I think what we have to convince our interlocutors in Europe, in the various member states, is to convince them that taking the creditors debtor divide I talked about, those, let's say, the pure risk reducers, which are, let's say, the creditors, and the pure risk sharers, which are those on the debtor side, are the worst enemies of themselves. If you think that you do everything under, let's say, putting only the emphasis on risk reduction, the impact, with calling for debt restructuring without all the necessary conditions, you get such a financial Armageddon that you are doing more bailout eventually, no more bail-in. And the same thing applies with a different sign for those who only put the emphasis on risk sharing. So yes, more adults in the room are needed.
Wow. That was, to me, quite profound, especially the bucket of what you do in market versus post-market versus pre-market. I'm sure our panelists would have more to say, but for those of you with us here live in the audience, let me open it up to questions. Anybody want to make a comment? I mean, we're getting very personal here. You can make a personal confession or comment or pledge your soul if you prefer. Fred, so let's get the microphone, please.
I'd like to pick up on something that several of you raised, which is the German question. Pierre, I thought, was remarkably sharp in his criticism of Germany in his remarks today. He said 8-9% surpluses can't go on forever. Germany is viewed as the permanent beneficiary of the European system, and that just can't go on. Now, Charlie said, he's right, he'd rather have a system that benefited Germany so it stayed leading the system rather than the reverse. Right. And Marco was just raising questions about the creditors shooting themselves in the foot. And of course, Germany's a leader of that segment. So question, what is it going to take? I mean, German's German, but he's been laboring in the same direction for a long time himself. What's it going to take to convince Germany that it undermines its own interests in maintaining a strong Europe in which it can be embedded, unless it does the kind of things that Pierre was talking about, Mario was implying, to take a more expansionary approach, alleviate to some extent the problems of the periphery, run down those big surpluses, and cut off before it becomes too late the perception around the rest of Europe that really, at the end of the day, it's all for Germany. I mean, I tried to lecture Helmut Schmidt on that. I mean, he basically, Helmut Schmidt, last conversation I had with him was 95, agreed and worried, was terrified that particularly with France's demise at the time, that Germany would be left really alone and would suffer the worst of all worlds. And I think ratified the view that Germany was risking its own future by not realizing how precariously it put its own position. What is it going to take after all these years of debating it, presenting it, what's it going to take? You would have thought Merkel was the leader to make that change. Even she has been unable to do it very satisfactorily. What is it going to take before, as to Jeremy's list, the Eurozone and Europe maybe breaks up from the other side because the rest of the zone hasn't had it with Germany?
Maybe we start, I'm happy to have Marco comment, but I fear he shouldn't. Maybe we start with Patrick, since you were in one of the other hotels during the crisis.
I mean, Fred's question is a very big question about Europe, and it's not just about the euro. The euro story and Germany's role in it, in a way, there are disappointments on all sides. I don't want to in any way defend a number of things that the German government did during the crisis, but really the problems of the crisis were generated by very poor behavior by Club Med and, you know, Ireland as well. And so they really messed up. They said, we would love to have a stable currency and we're signing up for the euro. And then they sat back and thought, well, that's all the fiscal and macroeconomic problems are now solved and we don't need to think about them. And they messed up rather badly. Now, what should have been done then? I agree fully with Jeremy that, for example, when the Greek situation became so disastrous, there should have been restructure right away. And Germany's role there was a tangled one, which leaves them holding a lot of, you know, hard to recover debt and a huge burden on Greece. So it was badly managed. But from the euro, and I think that the euro next phase of the euro, there will be better behavior from the Club Med, and they will realize, and they do realize, that it was themselves. I know there's a narrative that says austerity came from the euro. That narrative is diminishing as people realize, actually, it wasn't the euro created the austerity, it was the boom and bust cycle of behavior. Adam asked, is it an external threat that will... And it just occurred to me to mention that, yes, you had 3 new members at post-crisis in the euro area, and they have joined, I think, Baltics, to some extent at least, because of the external geopolitical threat. For me, Fred asked, what's it going to take? What it's going to take is a better political structure in Europe. When it comes to political decisions, everybody retreats into their national house. People say, Europe has decided, they have decided, not we have decided. And there are quasi-democratic structures, but they have not become embedded in people's, in the actual decision-making in Europe. It's very centralized in heads of state and ministers, the commission to some extent. It hasn't really become a felt political community. And until it is, and the euro crisis has damaged that as well. People, as you talked about, Greece, twice. Don't forget the time when Papandreou was basically stood down as prime minister of Greece at the behest of not of his own democracy, but of other heads of state. That was a terrible assault on democracy. And until Europe gets the democracy dimension more embedded, that's the solution that it requires. And then Germany will only be, and Germans will only be part of a wider polity. Can it be done? How can it be done? I don't know.
Rebecca or Charlie, do you want to come in on anything related to Fred's question?
I love your solution because that's kind of a happy, benign, kumbaya solution. I would say another path that one could get there is kind of picking up on your comments that just the right size crisis. You know, if Germany's trying to figure out how it stays cutting edge in a world where Huawei is leading on 5G, for example, and made in China 2025, et cetera, and if they have a diminishing population and labor force, and they're losing their cutting-edge reputation on a technology point of view, possibly, I'm not suggesting this will happen, but if you saw 1/3 of the euro area economy suffering, feeling like it might be losing its place in the world, maybe that's just the right crisis that makes them realize we actually need this, we're stronger together. So that might be another path to get there, although it wouldn't be a very fun one.
Yeah. Charlie, anything?
It's a great and puzzling question. I mean, to some extent, it's in their DNA. And as you said with Schmidt, you sort of put these issues on the table, and it goes right through them. They don't engage. And I don't, I don't know. I mean, Merkel was an extremely risk-averse, consensus-oriented leader. It's possible that when she leaves, whether it's a year from now or 2 years from now, you could see more flexibility. I'm not betting on that because her successor looks to be from the same background. I guess the one thing I'd say is it comes back to your question, Adam. They're freaking out a little bit about the world. And there is a debate in Germany now, very active, about where the United States is headed. Is the post-American era inevitable? If so, what does that mean for us? And I don't know where that debate's going to head, but I think that's one place where you could see some movement, because they just need to grow up in a world in which Europe is more on its own.
Chairman, speaking for yourself, not speaking for your nationality in best European way.
Okay, I'm just going to try to explain why it's so difficult to do this convincing, right? And from there, presumably there will be somewhat an implicit answer. So there is a reason that just has to do with the domestic politics in Germany over the last, basically since the beginning of the decade, more or less, where we have had, successive grand coalitions, and the formula around which these grand coalitions were built is agreement on the Black Zero. And the reason why this was easy to agree was that Social Democrats are panicky about being portrayed as spendthrifts, as not taking care of money. And formerly conservatives of the CDU have moved so far into the center on social policies that the only thing that distinguishes them, in some sense, is insistence on fiscal rectitude. And so these coalitions have coalesced around fiscal austerity, not austerity for Germany, right? Austerity maybe for the rest, but certainly on no deficits. And you need to get away from that political dynamic, and one can imagine how that would be the case, but I think it would require sort of a government that can sort of define an identity that gets respect with the center right, on some form of economic reform that does not require it to place all its eggs into this fiscal conservative basket. Now, the problem with this is that you also need to make an intellectual case, right? And so the intellectual case for big fiscal expansion in Germany to help the rest of Europe is not as obvious to Germans, and Beatrice knows this better than I, as you make it out, as we make it out from this side of the Atlantic. So roughly, this is how Germany got to its high current account surplus. So it had a recession, partly because it was overvalued in the early 2000s. That has to do with the way it entered the euro and with the overhang from unification. It over-adjusted from that, right? So it over-adjusted in the sense of really putting downward pressure on wages and prices. At the same time, it had a positive China shock, which had to do with the fact that the Chinese, just out of a miraculous coincidence, turned out to just require the types of goods that Germany was able to produce at a comparative advantage with at that point of their development. So that was the second point. Now, normally, what you would have expected, and of course, then you have the fact that pre-crisis, the rest of the Eurozone became overvalued, right? So it went in reverse. Now, the problem is that after the bust, there was no unwinding of this. And this is where, the median German is very hard to convince. So for the median German, the rest of Europe has not done after its bust what Germany did after their bust 5 or 6 years earlier. And, the reasons, of course, why that is it was much harder to do in the post-GFC bust phase is because at that point we had gotten into a effective lower bound, low inflation type situation where the type of adjustment that Germany did in the mid-2000s is far more painful. And so, for me, then the issue of lack of adjustment of the rest of Europe is tied to that particularly macroeconomic situation. And so, the answer is indeed fiscal stimulus in the part of Europe that still has the fiscal space. But remember that the sort of implicit alternative to that fiscal stimulus would be adjustment in the rest. So from a German perspective, you are telling the German taxpayers, please spend, and we're talking about a lot of money, right? In order to get down from 8% to say 5%, we're talking about maybe 6 points of GDP in fiscal stimulus. You're basically telling the German taxpayer, please indebt yourself nationally so that the rest of Europe doesn't have to adjust. And in the German parliaments, the sentence, the rest of Europe doesn't have to adjust, translates, and they don't have to reform. And of course, it is, true that there are deflationary and non-deflationary reforms, but, by and large, some of the type of labor market reforms that Germany did arguably are not just good in terms of lowering wage levels, but also perhaps increasing flexibility, perhaps increasing productivity. So, the sort of connotation is that maybe these are not the types of reforms that are necessarily inefficient. And, we should really make everything possible as Germans to let the rest of Europe off the hook of doing these reforms, because ultimately maybe these reforms are good for them too. So it is kind of a difficult and nuanced thing. And so my sort of proposed solution to this is, we have to sort of focus on productivity enhancing reforms that are not deflationary. That's sort of part one of the answer. But then we really expect the others to do this, right? Part two of the answer is it's probably unrealistic to expect a very large fiscal stimulus from the Germans to correct a big imbalance problem in the euro area and so if it requires fiscal stimulus, which I think it does, that it probably should be a central fiscal stimulus rather than German. And the big difference is then, if that were the case, it would be Europeans that pay jointly for the reflationary effort, if you wish. And so in principle, it should be easier to stomach. But of course, even that possibility is very far from the realm of the politically feasible, because that would require a central fiscal capacity that can create debt at the European level, right? And so we are stuck. But it's a rather more complicated problem, I think.
But what you need on your first scenario is a grand bargain. That's easy either. Yeah. A grand bargain with some of the structural reform improvements and certain big fiscal stimulus.
I think I'm afraid we're going to have to cut it off there. Marco Budi has a day job as Director General and has to go to the G20 or the IMFC or whatever it is the important people are doing this weekend. I want to thank all of you who engaged. I want to particularly thank my 5 genuine friends and colleagues who gave so much intellectually and personally to this discussion, and especially to Marco for, as a thinking policymaker, hearing out the kind of discussion we had. So please join me in thanking Marco, Patrick, Rebecca, Charles, and Jeremy.